we appear to be sort of at the precipice of potential trade war, lots of talk about tariffs. What does something like this do for CEO confidence? You know, it's such a departure, if you like, from years of stable policy.
So first of all, Ed, thanks for having me on. The question is whether we actually have a trade war or whether we just talk about it. So it's clear. I don't think what you've had over the past week really goes to confidence one way or the other. People will wait for the final result. If there was to be tariffs, and particularly when you talk about steel and aluminum, that would be concerning. Last time this happened 15 years ago, 200,000 jobs were lost. I think the markets are attuned to that. I think they're attuned to retaliation more generally. And that would certainly shake CEO confidence. But people will wait for the actual result rather than what happens from point A to point B until you get to the result.
So we're sort of able to discount the rhetoric at this point, to some extent.
Yeah, you see that today in the markets. So I think people will want to see what this turns out to be next week. But CEOs generally, you need to appreciate, since 2008, CEOs generally have learned to operate very nicely in a period of uncertainty, difficult decisions every day, and figuring out what matters and what doesn't is part of their job.
I want to get into the administration. So, you know, you were known previously as a Hillary guy. You were even talked about on Wall Street as potentially having a job in that administration should it have happened. It would be easy to get you up here to talk about things that we don't like about Trump. How has he surprised you on the upside?
So what I would say is, let's take on a policy. I think rate reduction in taxes, important, good for the economy, good for the private sector, has made us more competitive. And I think that over time, you're going to see, we see decisions happening every day where you'll see more investment back in people and processes and plant and equipment in the U.S. That's a good thing.
What about for M&A? Does the tax change have a sort of real impact?
Absolutely. You have more capital to allocate, and that matters. I know there's been a lot written in the past week or so about buybacks going up with a lot of the cash. The fact of the matter is, there's $2.5 trillion of cash overseas. That's a lot to spread across investment, across M&A, and across buyback.
So you have all this money coming back. We have people like Buffett, obviously, last week saying, you know, he's got $116 billion of cash. He doesn't know what to do with it. He knows he needs to go out and do deals, but the environment is tough. Valuations very high, et cetera, et cetera. People hire someone like Blair Effron to come in and advise them where to spend that money. What's the advice at the moment? Where are you telling people to go out and look for deals?
So first of all, most of the time, by the time we're involved, we're not saying go look for the deal. What is this? Here's the situation. Does it make sense? So what are we going to pay attention to? One, valuation. Obviously, valuations today we think are high, 18 times next year's earnings versus 16 times over 3 years. Two, you have to have a belief that you'll have economic tailwind a year and a half after you would do a deal. Because what happens early on in a deal is the most important thing in terms of measuring success. Three, the uncertainty of getting something done, and particularly on larger situations, there has been a lot more uncertainty between signing and getting something closed. So you have to be comfortable that the downside scenario, both in terms of not getting it done or getting it done on different terms, you'd still want to go ahead, that you're not putting your business at undue risk.
This is an easy point to pick up on the not getting it done. So we've seen, you know, Qualcomm, Broadcom obviously today become embroiled even more with CFIUS potentially looking at the deal and suggesting that there may be some issues there. Another big deal that seems to be wrapped up with the government at the moment, AT&T Time Warner. So two of the biggest deals out there for very different reasons are in front of the regulators. Is it possible in this environment to really do some of these mega mergers without sort of severe political scrutiny?
Severe? Who knows? Scrutiny? Absolutely. And any time you're going to do that kind of merger, you have to have that in your lens. And you have to assume that whatever assumption you may have made in terms of doability, that you're going to be wrong. And if you are wrong, are you still happy to go ahead and do it? And in the case of AT&T, based on the law, that deal ought to happen. My assumption is it will happen. But clearly, when something of that magnitude goes awry, it makes you step back and say, okay, I've increased my risk-reward ratio more towards the risk. How do I account for that in terms of the overall deal dynamic?
And does that kind of thing have a chilling effect on, I suppose, the willingness of other companies to go out and try and execute these big deals?
It certainly has an effect on protecting your downside. So a chilling effect, yes. So what does that mean in terms of a breakup fee? What does that mean in terms of your ability to get out of a transaction if it's not going the right way? And this all gets factored in. There's just a lot more uncertainty now in terms of getting big things done, and you need to be much more careful. And again, Ed, it goes back to valuation. You are willing to lean forward a bit more if the valuation metrics are really strong, and as soon as they get more into a gray zone, you got to be very careful.
Another area I want to go into is boutiques. So, it's in investment banking boutiques, not flower shops or trendy hotels. Independent investment banks. I know that's what they like to call themselves these days. So, in the post-financial crisis era, there was this whole, they were the anti-bulge bracket thing. There was, they had less conflicts. They didn't represent the sort of failures of Wall Street that people had associated during the 2008 crisis. What's the message now? Because I feel like that epoch is over. So what's the selling point for independent investment banks today?
So I have no idea. I know the selling point for Centerview, and I know that we compete against great firms that are big and great firms that are small. It's real simple. It's about quality. It's about intellectual capital. It's about doing the right thing for your client over the longer term. It's about training your people and mentoring the right way. And anyone who is going to try to compete because of a conflict or against someone else generally doesn't do so well. You have to actually compete on your own ideas, the quality of what you have to say, and that's something the independent firms have seemed to have done well. There's a reason that a lot of these independent firms in aggregate are probably, in any public transaction over $5 billion, you've seen 75% of them have some independent firm involved. So I think that corporate America generally has been educating themselves to the notion that you're really talking about two different industries. I want a universal bank for something, and I probably want something more bespoke for other matters.
And what is the hiring environment like? We sort of hear a lot about, younger people particularly wanting to work in other industries, in places like tech, and not necessarily being as drawn to Wall Street as in previous eras. Is that something that is a challenge, or is there still a sort of a wealth of talent out there?
A lot of talent. Clearly, tech, other parts of finance always get great talent. But the fact is, there's a great pool to draw from. In terms of firms like ours, we'll hire 30 kids out of college each year, and these kids are great. And it's our job to offer them a great path and a great career forward. I think the bigger issue for us isn't how much talent, it's finding the right talent and the right fit for ourselves. That's what every firm would do.